Bismillahirrahmanirrahim. Assalamu alaikum. We will continue with our course Investment and Portfolio Management. The course code is MGT531. Today's lecture is lecture number 24 and the reference is the same as we have been doing in the last lecture, that is by Christina. The study was conducted in 2010 about the investment analysis and portfolio management. Summary of the last lecture. In the last lecture we did a number of the topics, that was the strategies for investing in stocks, defensive stocks, interest sensitive stocks, consumer durables, capital goods. We also did a number of strategies as far as the investment decision about the stocks is concerned, and these strategies were sector rotation and business cycle strategies, market timing strategies, value screening strategies. And today's contents are about investment in bonds, main advantages of bonds, bond classification, coupon payment, collateral and quantitative analysis. What are bonds? We discussed in the last lecture a little bit, and what are bonds, and they basically securities which are provided by the government and by the other investors and corporations in order to the investors. And when the investors buy bonds, he or she becomes a creditor of the issuer, and buyer does not gain any kind of ownership right to the issuer, unlike in the case with equity securities. And some type of the bonds are on which the fixed payments are made on the installment basis, and on the other are variable payments are on, for the other they are variable. And for some bonds we have the payments on the maturity time of the bonds. What are main advantages of the bond? First of all, we will discuss main advantages of the bond. They are good source of current income. We can say that bonds are good source, or they are important source of current income. They provide the individual investor with the current income so that we can make the investment or we can fulfill our other needs. Investment to bonds is relatively safe from large losses, and in the case of default, bondholders receive their payments before shareholders can be compensated. So we can say this is another important feature, that they save us from large losses. That is, we can say that they are safe type of investments, and if there are default bondholders, then they receive their payments before shareholders can be compensated. And we have also major disadvantages of the bonds. What are disadvantages of bond? Major disadvantages of bond is that potential profit from investment in bonds is limited. That is, the level of profit is limited. Although they are safe, a safe type of investment, and we can get a safe type of money from their investment, but they are but their investment is, as far as the profit is concerned, we have limited profit out of this investment. Currently in the financial markets there are lot of various types of bonds. A number of bonds are basically traded, bought and sold in the financial market nowadays, and investors must understand their differences and features before deciding what bond would be suitable for his or her investment portfolio. Therefore, we can say this is very much important for the investor to decide first the nature and features of different bonds and the differences among different bonds, because there are a large number of bonds which are being traded in the market nowadays. Therefore, the investors, if they have the proper knowledge of the various types and various features of the bonds, and they can understand the differences among the bonds, they can decide that which types of bonds are more suitable or not suitable for them. And bonds classification by their features. By form of payment, non-interesting bearing, by the form of payment. By the form of payment, or as far as the payment is concerned and mode of payment is concerned, we have different types of bonds. Non-interesting bearing bonds. These bonds are issued at a discount rate, and throughout the bond's life its interest is not earned. We can say this is as far as the payment is concerned, so these are this type of bond. For them, throughout their life their interest income is not earned. However, the bond is redeemed at maturity for face value. Otherwise, we can find that according to their face value, the investor can find the money on at the time of their maturity of the life of bond. And then we have another important type of the bond which are regular serial bonds. Serial bonds in which all periodic installments of principal repayments are equal in amount. And then we have another important type which are known as deferred interest bonds. Deferred interest bonds with paying interest rate at a later date. Therefore, we can say that the non-interesting bearing bonds, the investor find the principal as well as interest according to the face value at the time of the maturity. And as when the serial bonds are concerned, all the periodic installments are equal in amount, and they are of the principal amount, they are equal in amount, and deferred according to deferred interest bonds, payments are made for the interest rate at a later date, which is basically deferred date. We have the classifications of the bonds. Continuing with the classification of the bonds, we have income bonds, and these the bonds on which interest is paid when and only when earned by the issuing firm. And that is, we can say that when the issuing firm they earn something on bonds, they pay the interest rate for it. And another important type is indexed bond. These are the bonds where the values of the principal and payout rise with inflation or value of the underlying commodity. Then third is optional payment bonds. These bonds that give the holder the choice to receive payment on interest or principal, are both in the currency of one or more foreign countries as well as in domestic countries. And then we have coupon payments. The type of or the mode of coupon payments, how the coupon payments are made. Coupon bonds are the bonds with interest coupons attached, that is the interest rate coupons are attached with these bonds. That is why these bonds are known as coupon bonds. And the first type is zero coupon bonds, which is important and interesting type, that the bonds sold at a deep discount from its face value and redeemed at maturity for full face value. Therefore, these are different types of the bonds which are basically indicated here according to their mode of payment, according to their level of payment, and according to their level of the life and maturity. And therefore, it is this knowledge and information is important for the investor to understand properly and to acquire information properly in order to make the decisions, in order to make their investment for their portfolio. The difference between the cost of bond and its value when redeemed is the investor return. So what is the difference between the cost of the bond and its value? When redeemed is the investor. This is the difference between the cost and the value is basically the return to the investor. That it is the rate at which the investor buys a bond and the investor sells a bond, and what is the value of the bond. The difference gives the investor the return and facilitate him to get the capital gain. These securities provide no interest payment to the holders. And then we have another important type which are known as full coupon bonds, bonds with the coupon rate near or above current market interest rate. What are full coupon rates? These are, as we have already discussed, that the return basically is the difference between the cost of purchasing of the bond and the value of the bond. And when we find that bonds with the coupon rate near or above the market value and market interest rate is known as full coupon bond. Then we have another type which is known as floating rate bonds, the debt instruments issued by large corporations and financial organizations on which the interest rate is pegged to another. Often the treasury bill rate and adjusted periodically at a specified amount over that rate. So these are known as floating rate, that is the instruments issued by large corporation on which the interest rate is pegged to another rate. This is an important type of the bond on which through an important way the interest rate is paid to the investor of the bonds. Then we have secured bonds. Secured bonds are the bonds secured by pledge of the assets, plant or equipment. That is, we can say that these bonds, these types of bonds, they are secured by the pledge of the assets, and assets can be plant, it can be equipment, and the title to which is transferred to bondholders in the case of core closure. Then we have another important type which is known as unsecured bond, and these are the bonds backed up by the faith and credit of the issuer instead of pledge of assets. This is another important point which show the morality level of the people of any nation, that how much people have moral values and they are sticking with the moral values, that they just the purchase of the bond is made upon the faith and is made upon the belief and credit of the issuer rather than in the pledge of the asset. That is, there is no need to pledge the assets, there is no need to pledge the plant or equipment or any other precious item, rather the purchase is made on the basis of the faith, on the basis of the belief of the others. And then we have another important type of bond which is known as debenture bonds, the bonds for which there is no any specific security set aside or allocated for repayment of principal. This is known as debenture bonds. There's no collateral required for the allocation of the repayment of principal. So these are basically known as collateral bonds, because for these bonds the collateral is required either and is paid, and on the other hand it is required but not paid, and is based on the beliefs and faiths and mutual understanding of the buyer and the seller. Then we have another important type which is known as mortgage bonds or mortgage-backed securities. These bonds that have an underlying security is a mortgage on all properties of the issuing corporation. And then we have sinking fund bond. These bonds are secured by the deposit of specified amount. Therefore, we can say that they are known as sinking fund because the security is based on the deposit of specific amount, and specific amount is deposited to the seller of the bond and is known as sinking fund bonds. The issuing corporations makes these deposits to secure the principal of the bonds, and it is sometimes required that the funds be invested in other securities. Then we have asset-backed securities. They are known as ABS, similar to mortgage bonds, but they are backed by a pool of bank loans, leases and other assets. So we can say asset-backed securities are basically, they are the same as mortgage bonds, and they at their back they have a pool of bank loans and leases and other assets. The asset-backed securities are related with the new market terminology. And what is this terminology? This is that securitization, which understood as the APS are related with the new market terminology. And what is this new market terminology? That securitization, which understood as the process of transforming lending vehicles such as mortgages into marketable securities. The main feature of the asset-backed securities for investors. What is the main feature? Relatively high yield. That is, the asset-backed securities, they provide high yield to the investor. Shorter maturity is 3 to 5 years. That is, time period to be mature is not so long. It is 3 to 5 years only, and we can say that after some time the investor will be able to get the payments on the bonds, and monthly rather than semi-annual principal and interest payments. So therefore we can say that the important feature of the asset-backed security is that they give higher returns to the investor. They carries and they are associated with the shorter time period of maturity, which may comprise of 3 to 5 years, which may comprise of the monthly basis and rather than and not on the semi-annual basis, that is twice in a year. Principal or interest payments, and the principal and interest payments they are not paid twice in a year, but they are paid on monthly basis or in a short time period of 3 to 5 years. From their introducing to the market, they were ranked as high credit quality instruments. So they are basically they are known as high credit quality instrument. But the recent financial crisis showed that these debt instruments could be extremely risky investment. When bank loans portfolios as a guarantee of APS become worthless, causing banks insolvency problems. We can say that there can be risky situation. Recently, the crisis and financial crisis shows that the debt instruments could be extremely risky investment. That debt instruments, they are a sort of risky investment, and because when the guarantee becomes worthless, causing the bank in a problem, and repayment cannot be made, it creates problems and financial problems and problems of the repayments to the bank. General obligation bonds, then this is another important type of the bonds which are known as general obligation bonds, and bonds secured by a pledge of the issuer's full faith and credit, usually including unlimited tax power. And we can say that general obligation bonds are the bonds which are secured by the pledge at the faith and at the credit, and they include unlimited tax power. And what are the guaranteed bonds? Bonds which principal or income or both are granted by another corporation or parent company in case of default by the issuing corporation. The participating bonds. The participating bonds are the bonds which, following the receipt of a fixed rate of periodic interest, also receive some of the profit generated by issuing business. And we can say guaranteed bonds are important. Participating bonds are another type of important types of bond. That is, we have number of the bonds which have different characteristics, which have different type of payments, interest payment, different maturity times, and they basically provide the guideline for the investor that which type of the investment to make in terms of bonds, or which type of investment should be avoided in order to have proper portfolio holdings. And guaranteed bonds which principal or income or both are guaranteed by another corporation or parent company in case of default. So here the guarantee is basically required in the case of the default by the issuing corporation. Therefore, we can say that in this case it is a sort of a help for the investors or for the buyers of the bonds. Participating bonds which the receipt of fixed rate of periodic interest rate, that is participating bonds, they involve a receipt of fixed rate of the interest rate and receive some profit generated by the issuing business. Then we have another type of bond which are known as revenue bonds, bonds whose principal and interest rate are to be paid solely from earnings. So we can say that their principal amount as well as their interest rate, they are paid from the earnings of the bonds. That is why they are known as revenue bonds. We can, in other words, we can say that the name of the bond is indicating the meaning of what basically it means. Then we have another important type of the important topic as far as the investment in terms of bond is concerned. It is the types of circulation. What is the type of circulation of the bonds? We have convertible bonds in this respect. And what are convertible bonds? The bonds that give to its owners the privilege of exchanging them for other securities of issuing corporation on a preferred basis at some future date or under certain condition. What are convertible bonds? ये वो bonds हैं जिनकी वजह से जो ओनर है उसको इतनी privilege मिल जाती है कि वो अपने bonds को अगर किसी और सिक्योरिटी में जो कोई और कॉर्पोरेशन जो है वो इश्यू कर रही है उसमें कन्वर्ट कर सके एट सम फ्यूचर डेट, कोई किसी फ्यूचर टाइम पीरियड में या किसी मैनेज जो है वो कंडीशंस के तहत, ये कुछ कंडीशंस के तहत जो है वो ये सारा कुछ कर सके. देन और दिस कैन फैसिलिटेट द इन्वेस्टर दैट इफ दे वांट टू चेंज देयर टाइप ऑफ इन्वेस्टमेंट, दे वांट टू ट्रांसफर और एक्सचेंज देयर इन्वेस्टमेंट फ्रॉम वन type of bond to the other type of bond. They can do this, and definitely they can feel comfortable as a result. If for example if they have bought some type of bond and they are not comfortable with that portfolio item, so they can exchange for another security, and so that they can feel comfortable and they can feel that they have made a proper decision now in order to optimize their choice. Then we have interchangeable bonds, bonds in coupon form that can be converted to the other form or its original form at the request of holder paying the service charge for this conversion. Interchangeable bonds, that is when the bonds can be interchanged with each other. For example, if there are two investors, they can interchange bonds with each other, and after paying the charges of the service for the corporations who are issuing agency or issuing corporation. This is another interesting method with the help of which if on the course of the investment and when before the maturity of the bonds, if they want to change, investors want to change their bonds, they can change. And if there are two parties, then they can exchange with each other after paying certain service charges, and in this way they can again optimize their portfolio investment and portfolio set. Types of issuers. How much are and what are the types of issuers of these bonds? We have treasury or government bonds. On first hand, we have treasury bonds, which are also known as government bonds. This is an obligation of the government, and hence bonds are of highest quality in each domestic market because of their issuer. Because the government these are known as issuer bonds, or these are known as government bonds because its supplier or issuing authority is the government, and the people feel satisfaction with the purchase of it, and when they purchase bonds, they feel satisfaction. They think that it is a high quality bond in the domestic market, and they can definitely get out of it. They will not have to face any type of loss as far as the government bonds are concerned, and there will be no problem of the default, and the investor will comfortably sell their bonds when they want, and they can receive their interest as well as their principal amount when they sell their bonds. This guarantee, together with their liquidity, makes them popular with both individual and institutional investors. The government bonds are dominant in the fixed income market. Government bonds, they basically take the dominant place in the fixed income market. And then we have another important type, which is known as municipal bonds. Municipal bonds, they are issued by the political subdivisions in the country, and they in the country and in the city. And municipal bonds, they are also a sort of they are government bonds, and they are dominant in the fixed income market as far as the income market is concerned, and they are issued according to the political subdivisions in the country, and they are therefore accessible to the people from their local areas. People will not face any type of difficulty at the time of the purchase, at the time of the sale, and also in terms of the payments. And we can say that their liquidity makes them popular both at individual and institutional investors. Individual as well as institutional investors, they would like to invest in two types of bonds, which are known as the government treasury bonds or the municipal bonds. Then we have corporate bonds. These are a long-term obligation of the corporation. That is basic, as the name of the bond is indicating that these are provided and issued by the corporation, and it is a long-term obligation of the corporation to issue these bonds. Then we have another type of the bonds, which are known as industrial bonds, and bonds issued by the corporation other than utilities, banks, and railroads. Therefore, we can say that the industrial bonds, they are issued by the corporations other than utilities and banks and railroads. Banks do not and utilities do not sell them, but this is these are issued by the industrial sector, and this debt is used for expansion, working capital, and retiring other debts. So we can say that this type of debt is used for the expansion of the investment and for expansion of the working capital, that is to purchase more capital and retiring and in order to retire the already existing debt. Then we have another important type, which is known as public utility bonds, and these public utility bonds, they are high quality debt instruments issued by public utility firms. We can say that public utility firms, they issue these instruments and these bonds, and they are good quality bonds, which are basically their quality is likely to satisfy the investor and buyer and purchaser of these bonds, and are helpful to facilitate the bonds as far as their psychological cost is concerned, and they feel relaxed with the purchase of these bonds. Then we have recall possibility. Callable or redeemable bonds issue all or part of which may be redeemed by issuing corporation under definite conditions before the issue reaches maturity. That is, we can say if this situation happens, then the bonds on all or partially may be redeemed by the issuing corporation and before the maturity time reaches. This is another important aspect of the callable bonds. Then we have non-callable bonds. These are irredeemable bonds, and these bonds issued which contains no provision for being called or redeemed prior to maturity date. These are the bonds which basically involve no provision for being called or redeemed before the time of the maturity and before these bonds become mature. Then we have another type of bonds which are known as internal bonds. These bonds issued by a country payable in its own currency. We can say that these are internal bond and known as the name of the bond is indicating that these are basically traded in its own currency in terms of, and payments are made in terms of the own currency. And then are the external bonds. Bonds issued by government or firm for purchase outside the nation, usually denominated in the currency of the purchaser. The term Eurobond is often applied to these bonds that are offered outside the country of the borrower and outside the country in whose currency the securities are denominated. As the Eurobond market is neither regulated nor taxed, it offers substantial advantages for many issuers and investors in bonds. Therefore, we can say that Eurobonds, they are another type of the bonds which are important, and they are offered outside the country of the borrower and outside the country in and the currency of that countries, and the securities are currency of that the other country is basically denominated. And the Euro market, this market is neither regulated nor taxed. This is another feature, important feature of this market, that Eurobond market is neither regulated nor taxed. It offers substantial advantages for many issuers and investors. That is, those who are buyer in this market, those who are seller in this market, they get a huge and significant number of advantages when they make their purchases in this market, when they trade the bonds in this market. So this is another type of facilities that is provided to the investors in the Eurobond market. And the quality as far as we are here talking about the place of the circulation of these bonds, internal circulation or external circulation. Then quality is another important thing. Gilt-edged bonds, these are known as gilt-edged bonds. These are high-grade bonds issued by a company that has demonstrated its ability to earn a comfortable profit over a period of years and to pay its bondholders their interest without interruption. These are gilt-edged bonds. These are very good quality bonds and high-grade bonds, and are known as high-grade bonds because the company which issue these bonds, it gives earning to the investor on comfortable basis, and they have ability to earn a comfortable profit over a period of time, and reasonable amount of profit over a period of time, and they make the payments on preferable basis without interruption and without giving any tension to the creating any problem to the investor. Therefore, we can say that this is basically the good quality of these types of bonds, that there is no danger of default of the issuing company, and the investor they can invest in these types of bonds with very facility and happily, in the hope of earning some rate of interest. Then we have another important type which are known as junk bonds. What are the junk bonds? Bonds with low rating, also regarded as high yield. Although they are high yield, but they are low rating bonds, and definitely no matters if they are low rating bonds, but as they are high yield bond, that is why they are attractive to the investors, and they are preferable to the investors. These bonds are primarily issued by corporation and also by municipalities. So we can say that these bonds are important bonds. The corporations and municipal committees, they issue these bonds and provide them to the investors. Other types of bonds, they have a high risk of default because they are issued as unsecured and have low claim on assets. We can say that the other types of bond, as far as junk bonds are concerned, if we discuss the previous slide, so among the junk bonds we can say they are low rating but high yield bond. They are issued by municipal corporations and other corporations, but they are risky because they are unsecured. There is no security, there is no collateral for these bonds, and and have a very low claim on assets, and therefore we can say there is a high risk of default, and the investors may be reluctant and in order to purchase these bonds and in order to make investment in this type of bonds. Then we have other types of bonds, and among other types of bonds we have voting bonds. Unlike regular bonds, these bonds give the holders some voice in corporation management. That is, they are basically associated with the management of the corporation. And then we have senior bonds. The bonds which have prior claim to the assets of the debtor upon liquidation. Then we have third type of other bonds which are known as junior bonds. These bonds which is subordinated or secondary to the senior bonds. So we have different important types of the bond. First are known as voting bonds. Second important type is known as senior bonds, and third are known as junior bonds, which are basically subordinated to the secondary or the high and subordinated or secondary to the senior bonds. As far as the bond analysis is concerned, we have the structure and contents. Similar to analysis, when investment in stock, investors before buying bonds must evaluate a wide range of the factors which could influence his or her investment. Therefore, we could basically, when we undertake the investment in stocks, we have the investors have to analyze a number of the things, a number of the factors which are prevailing and which are affecting creating the demand situation and affecting the supply situation. And similarly, before investing in the bonds, we must evaluate a wide range of the factors which can influence this investment and which can lead to affect the results of the investment. The key factors are related with the results of the performance and financial situation of the firm which is issue of the bonds. And various indicators are used for the evaluation of these factors. The first is bond analysis includes, second quantitative analysis, third are qualitative analysis. So we have these three important types which are known as which come up under the different indicators for the evaluation of the factors in order to evaluate the worth of the bond, and these include which are used for the analysis of the bonds. And we conduct the bond analysis, we conduct quantitative analysis, we conduct qualitative analysis in this respect to analyze the situation in order to make the investment in terms of bond more profitable to the investor. And for the bond analysis, we have quantitative indicators, the financial ratios which allows assessing the financial situation, debt capacity and credibility of the company issuer of the bond. Therefore, we can say as far as the quantitative indicators of the bond analysis are concerned, we have to undertake the financial ratios. And what these financial ratios do? These financial ratios, they assess the financial situation prevailing in the bonds market, and what is the debt capacity, how much that can be obtained, and credibility of the company, what is the level of credibility of issuing company which is issuing the bond and providing the bond to the bond purchasers and holders. Since the bonds are debt instruments and the investment in bonds really becomes the creditor the most important during the analysis is the assessment of credibility of the firm issuing of the bonds. And we say that because the credibility of the firm which is issuing the bond or corporation and credibility of the corporation which is providing and issuing the bond is very much important to consider and to analyze. We can say the purchaser or the investor who is buying the bond becomes basically the creditor of the bond, creditor towards the corporation which is issuing the bonds or towards the firm which is issuing the bond. And this is very much important relationship of the investor or purchaser of the bond and supplier of the bond. And we can say that basically this analysis can be defined as the process of assessment of the issuer ability to undertake the liabilities in time. That what is this is again another aspect with the help of which, another feature with the help of which we can judge the quality of the issuing company or issuing corporation, that is we can assess the issuer ability to undertake the liabilities in time, whether they can undertake the liabilities in time or not. In this is another way or the technique with the help of which we can assess the quality and credibility of the company or the corporation or the firm which is providing and issuing the checks. And similar to the performing a fundamental analysis for common stock, both bond analysis uses financial ratios. Therefore, we can say that another important way with the help of which we can analyze the worth of the bonds is the same as we did for the purchase of the common stock. That is, we performed the fundamental analysis for the common stock, that which common stock is better to hold or which common stock is not good to hold or good returns giving to hold. It was done because a large number of common stocks were available in the financial market to be purchased, and it was very much difficult to take the decision among a number of the common stock. That is why we can say, as it has been done for the fundamental analysis of the common stock, the bond analysis or credit analysis uses financial ratios. That is, with the help of the financial ratios, this analysis can be taken place for the bond analysis or credit analysis. However, the analysis of bonds differs from the analysis of the stock. That how the analysis of stock and the analysis of bonds, they are different from each other, because the holder of the regular bonds has not any benefit of the fact that the income of the firm is growing in the future. That is the difference basically indicate that the person who is trying, or the investor who is holding the regular bonds, and they do not take any benefit that the income of the firm is growing in the future time period, because if the income of the firm increases in the future time period, that will be for the future time period. However, financial ratios, they are very helpful to undertake the analysis. They are very helpful to be fully aware as far as the purchase of different bonds is concerned, and as far as their return is concerned. Now, the dividends are growing. These things are important to the shareholders. Or if the dividends, they grow and they are increasing, they are improving over the passage of time, they are showing positive trend on the passage of time, it is very much important to the shareholder. Instead of this, investor in bonds is more interested in the credibility of the firm, its financial stability. Continuing with the quantitative analysis, estimation of financial ratios based on the main financial statement of the firm is the balance sheet, profit and loss statement, cash flow statement, etc. is one of the key instruments of the quantitative analysis. We can say that if the financial ratios, they are calculated, if they are estimated, and on the basis of the financial statements provided by the firm and the industries, and these financial statements are basically are known as the balance sheet, are provided through the balance sheet, and they give the profit to loss statement ratio, and they give the cash flow statements, and they are important instrument or important factor in order to conduct and in order to undertake the quantitative analysis. And if we are able to calculate these, and if we are able to estimate these ratios, we will be able to analyze that which type of bonds should be bought or which bonds should not be bought, in order to improve the economic situation, in order to earn something and to make a good portfolio investment. Some ratios used in bond analysis are the same as in the stock analysis, but most important financial ratios for the bond analysis are. Here we can say, although some ratios are among the bond analysis and the stock analysis, they are of similar type, but we have the important financial ratios for the stock and bond analysis. They are of this type. The first is the ratio of debt to equity ratio, second is debt to cash flow ratio, third is the debt coverage ratio, and fourth one is cash flow to debt service ratio. And these all are important in order to analyze the situation in the bond market, and that is what is the ratio between the debt and equity of the firms, and what is the ratio between the debt and cash flows of the firm, what is the ratio between the debt and coverage and cash flows and debt service ratio. All these things, and through the balance sheet, they make the position of the issuing company very much clear, and the people can have a proper guideline in order to undertake their decision, in order to make the proper investment in their in the bonds, and to keep them as a part of their portfolio set. Another importance is debt to equity ratio. Debt to equity ratio is equal to DL to set is known. The formula is this, where DL is long term debt and SET total shareholders equity. So debt to equity ratio is equal to DL to SET, where DL indicates long term debt and this SET indicates shareholders equity, or tells us that what is the debt to equity ratio. This shows that financial leverage of the firm. Equity represents the conservative approach of the firm financing, because in the case of financial crisis of the firm, dividends are not paid to the shareholders. That is why it is known as conservative approach, that financial problems are faced by the firm and firms come up with this with the economic crisis. As far as the issuing of these bonds is concerned, then what happens that the firm will not pay the dividend to its shareholder. While repayment of debt and interest payment must be undertaken despite of what is the level of firm profitability, and repayment of debt is important to be made, and interest payments must be made to the investors and to the lenders, because it must be despite of what level of profitability is that, and that these should have no, these repayments of the debt and the interest payments must have no concern with the level of profitability of the firm. Rather they should be paid, and that should be repaid, and interest payments should be made to the investors for the good reputation of the firm, issuing firm. The higher the level of this ratio is the indicator of increasing credit risk. If this ratio is high, debt to equity ratio is high, we can say that the credit risk is high. And estimation of this ratio is based on the data from the balance sheet of the firm. And as we can calculate this ratio, we can calculate this formula and this information if we have the proper balance sheet and we have the proper data available on the balance sheet. Continuing with the quantitative analysis, we see that debt to cash flow ratios is equal to DL plus LP divided by NI over DC. And what we find here, that LP is known as lease payment, NI is net income, and D is depreciation. Therefore, we can say that LP indicates the lease payment, and this is the ratio of the lease payment towards the plus long-term debt towards the net income and the depreciation. Debt cash flow ratio shows the number of the years needed to the firm to undertake all long-term liabilities and leasing contracts using current generated funds cash flows by the firm. Of course, this is practically unbelievable that firm could use such an aggressive debt repayment plan. However, this ratio is an effective measure of measure of firm's financial soundness and financial flexibilities. Firm with the low debt cash flow ratio can be borrowed needed easily at any time. From the other side, firm with the high debt and cash flow ratio could meet substantial problem. If they would like to increase the capital for their business activity by borrowing, estimation of this is based on the data from the balance sheet, which is long-term debt, and that data will be about the long-term debt, profit loss statement, net income, depreciation. And if we have data according to the variables and relevant to the variables, we can calculate the debt to cash flow ratios, and this cash flow ratio can borrow funds needed easily at any time, and they are helpful to guide the firm to meet this and to face the substantial problem as far as the funding is concerned. And it would be the situation, and this practical and this estimation would be helpful to increase the capital for the business activity by borrowing. And then we say that the cash flow statement, if the depreciation is not showed, a profit or loss statement of the firm. And information about future leasing payments often is presented in the form in the off balance sheet statement. Therefore, we can say that this type of information through data of the balance sheet is important to calculate and estimate the ratios, and with the help of these calculations we can find out, and we can be able to find out the economic situation prevailing in the bond market. Debt coverage ratio, another type, is equal to EBIT over I. where EBIT indicates earning before interest and taxes. That is, before paying the taxes, before paying the rate of interest, what is the level of earning, and I indicates interest rate expenses of the firm. And with the help of the data available on these variables, we can calculate the debt coverage ratio, which is equal to EBIT to I. And debt coverage ratio sometimes is presented as interest turnover ratio. This is very important analytical indicator, and with the help of this we can analyze the situation, and with the help of this we can provide a guideline to the investors and to the stream of investor to make their investment, and they can decide whether they have to make investment or not to make investment when they find the proper analysis of the situation. And they will invest in bonds if they find it profitable, and will not invest if they do not find it profitable. And the firm with the higher ratio is assessed as financially stronger. So we can say that the firm which is having higher debt coverage ratio is financially and economically stronger as compared to other firms. When analyzing this ratio, it is not enough to take only 1 year result of the firm, but it is necessary to examine the tendencies of the changes in this ratio during long period time. It is especially important to analyze how the firm has managed to pay the interest on the debt when it is generated low income, that is in the period of economic crisis and other unfavorable conditions of the firm. Therefore, we can say that it is necessary to examine the tendency of the ratios, that in which direction these ratios are going during the longer period, whether they are showing a positive trend and upward slowing position, and during the longer period of the investment and longer period of the history of the firm. And if we find that the values are good and they are showing a financially stronger position, so we can say that the investor should invest in these. Otherwise, we can say that the if there is a situation that when the firm is issuing corporation or the issuing firm is facing a loss or facing economic crisis, it may not be possible for the firm to pay the rate of interest and to pay the principal amount to the firm. Then this is a sort of unfavorable condition, and this will create a problem in the market. Besides, this ratio shows that the reserve the firm has for coverage of the interest if the income of the firm would decrease. And the higher the reserve, the lower is the risk of the bond issued by the firm. And what is the solution for this? If the firm faces the economic crisis, in order to make the payments as far as the level of interest is concerned, we can say that the firm has reserved a certain stock of the finances, certain stock of the money in order to make the payments for the interest rate. If the income of the firm decreases, if the income of the firm is no more increasing, rather it is going to decrease, then firm can make the payments for the rate of interest out of its reserves. And if the firm has made higher reserves, then lower the risk of the bonds issued by the firm, and the investor should not be worried about the bonds purchased by any particular firm, and they should not have the fear anymore, fear of the default of the firm. And therefore, we can say that the calculation of these ratios is very much important to guide the individual investor and institutional investor, and to facilitate the investors in order to make the investments in terms of bonds, to keep the bonds as a part of their portfolio. And definitely the analysis will enable the investor to be aware of the situation, that whether they are likely to have return out of the investment in bonds, or they are likely to face risk out of the investment in the bonds. And then continuing with the quantitative analysis, we find that the estimation of cash flows to debt service ratio includes the adjustment of the debt and interest payment by the corporation taxes. This is necessary because the sum of the debt repayment must be increased by the sum of the corporation tax, and thus the debt is deemed using net income, and the interest expenses Often leasing payments are the part of financial expenses of the firm. Although debt coverage ratio is a good measure for evaluation of credit level of the firm, however, many credit analysts consider cash flow to debt service ratio as the best measure for evaluation of the firm credibility. Therefore, we can say that cash flows to debt service ratio is very much important to make the situation clear about the quality of the firm and about the credibility of the firm, that whether the firm is credible or not, and the bond should be purchased from this particular issuing firm or should not be purchased. Therefore, we can say that the ratio of the cash flows to debt service ratio is very much important to make the situation clear as far as the analysis of the credibility of the firm is concerned. And their main arguments are generated income of the firm shows not only net income but the non-cash expenses, depreciation expenses as well. For creditor, not only ability of the firm to make payment of the interest is important, but the ability to repay the debt and to recover the leasing payments is important too. Therefore, we can say that the guaranteed income of the firm shows that not only net income but non-cash expenses also, and the depreciation expenses as well. And we can say that the income generated by the firm includes net income as well as cash expenses and the depreciation expenses, and the firm should, and the creditor to the firm, not only ability of the firm to pay the interest should, and the creditor of the firm should, and the creditor of the firm should have the ability to analyze that whether the firm is able to pay rate of interest and is able to repay the debt loan and to cover the lease payments in time too. Therefore, we can say it is important for the investor that he should analyze the situation carefully in the bond market as far as any type of the bond is concerned, as well, and also the economic status of the issuing firm, and that whether it is in the position to make the payments of the interest rate, to make the payments of the debt, and to cover the leasing payments in time, and should not delay the payments at all. And continuing with the discussion, qualitative indicators are those which measure the factors influencing the credibility of the company, and most of which are subjective in their nature and evaluation and are not quantifiable. So we can say that we have another type of evaluation of the bonds market and another type of the method which is likely with the help of which we can analyze the situation and economic situation prevailing in the bond market. This is known as qualitative indicator. And what are these indicators? These are those indicators which measure the factor influencing the credibility of the company. And what factors are basically influencing the credibility of the company which is issuing the bonds, and the qualitative indicator should be helpful in providing this information, and most of which are subjective. And as far as these indicators, qualitative indicators are concerned, most of them are subjective in nature and valuation and cannot be quantified. And although the financial ratios discussed above allows evaluating the credit situation of the firm, but this evaluation is not complete, and for the assessment of the credibility of the firm necessary to analyze the factors which are not quantifiable. And therefore we can say, in order to analyze the financial situation of the bond market as far as the particular types of bonds are concerned, it is very much important that the financial ratios should be evaluated and should be calculated. And we can say that the credibility of the firm can be analyzed with the help of quality of the firm and the quality of the bonds provided and issued by the particular firm. They can be analyzed in this situation, but with respect to qualitative variables and cannot be quantified. And this is the difference between the qualitative and quantitative approach and indicators to assess the situation, and in terms of the financial status and economic status of the firm. That as far as the qualitative approach is concerned, we use and look at the qualitative variables and factors. As far as the quantitative approach is concerned, we look at the quantitative aspect of the economic situation of the firm which is issuing the bonds. Unfortunately, the nature of the maturity of the factors and their assessment are subjective, wherefore it is more difficult to manage these factors. And however, this part of analysis in bond market is based on qualitative indicators is important, and very often is dividing the line between effective and ineffective investment in bonds. And then we have the group of qualitative indicators or dimensions. And what are the groups? Groups include economic fundamentals, the current economic climate, and overall economic and industry-wise factors. Then we have market position. Market position includes and indicates market dominance and overall firm size. The larger the firm, the stronger is the credit rating. And management credibility is the third important indicator, which and qualitative indicator. Quality, it shows that quality of the firm's management team. Then we have bond market factors, the term of maturity, financial sector, bond quality, supply, and bond for the credit. Then we have bond rating between bonds and bond quality. Now this is the end of the 2 days lecture, and now I will give the summary of the 2 days lecture, that what we have done in the summarized point. And as far as the contents are concerned, we are concerned with the advantages, disadvantages of the bond, and classification of the bonds, coupon payment, collateral, and quantitative analysis. And we know that bonds are the securities which may be provided by the corporations and the governments. Bonds are also provided by the municipals and by the local corporations. Their advantages are that they are safe sided investment, that is, they provide the investors with a safe type of investment, and there is even if there is default of the bondholders. In the case of the default, bondholders receive their payments before shareholders can be compensated. And so we can say that if the problem of the default rises there, even then bondholders have no problem with it. What is the disadvantage? As far as disadvantage is concerned, there are a large number of the bonds which are available, and we have to, as an investor, we have to make a choice very carefully that which bonds to purchase and which bond not to purchase, with reference to the difference and depending upon the differences and the features of the bonds, and what bonds should be suitable, and should be decided by the investors, that what bonds should be included in the investment portfolio on the basis that they are suitable. And bond classification by their key features and by the form of the payment. We have non-interest bearing bonds, we have regular serial bonds, deferred interest bonds, we have income bonds, indexed bonds, optional payment bonds, and coupon bonds, zero coupon bonds, and they have difference from each other on the basis of their cost, on the basis of their revenues, and on the basis of the mode of payment. Then we have the coupon payments. As far as coupon payments are concerned, we have coupon bonds, zero coupon bonds, we have full coupon bonds, floating rate bonds, and we have debt instruments. And as far as collateral bonds are concerned, we have secured bonds, unsecured bonds, and debenture bonds, mortgage bonds, and sinking funds bonds. All these are basically indicating the types of bonds which need collateral, or which basically needed collateral, and we have to provide, and investors have to provide collateral in terms of the assets, in terms of the precious instruments and equipments, and also the collateral can be on the basis of the faith and mutual understanding of the buyer and seller of the bonds, and can be based on the moral values. And then we have asset-backed securities. They are also similar to mortgage bonds, and they are backed by a pool of bank loans, leases, and other securities. And we can say that ABS are related with modern terminology of the market, which is known as securitization, and which understood as the process of transforming lending vehicles such as mortgages into marketable securities. And then we move further. We have other types of the bonds which are known as guaranteed bond and participating bond. They are revenue bond, and their names indicate their features, that what type of features they are possessing is indicated by their names. Then we have type of circulation, which are known as convertible bonds and interchangeable bonds. Then we have type of issuers, and treasury government bonds, and hence bonds are of the highest quality. They are type of issue shows that which body is issuing them. We have the government, which as an important body which is issuing the bond. We have and definitely we know that individual as well as institutional investors, they have belief on the government purchases, and they have full belief and faith on the purchase of the bonds from the government body. And government bonds are dominant in the fixed income market. And we have another important type which are known as municipal bonds, and they are issued according to the political subdivisions of the country, political subdivisions of the locality and the city. And we can say that they are easily accessible to the buyers, and buyers can sell them whenever they want upon the date of the maturity in their nearby market, and there will be no problem with that. Then we have corporate bonds. They are also long-term bonds having long-term obligations issued by the corporation. Industrial bonds, they are issued by the industry. Public utility bonds, these are also high quality debt instruments issued by public utility firms. Then we have, as far as the types of circulation is concerned, we have recall possibility, callable or redeemable bonds, and these bonds issue all or part of which may be redeemed by the issuing corporation under definite conditions before the issue reaches maturity. Then we have non-callable bonds, which contains no provision for being called or redeemed prior to the maturity dates. Then we have the nature of bonds and types of bonds according to place of circulation. We have internal bonds which are traded in internal market in terms of internal currency by the government. Then we have external market and euro bond, and they are externally provided and traded, and the market is known as Eurobond market. And this market is neither regulated nor taxed, and offers substantial advantage for the many issuers and investors in the bond market. Then we have quality gilt-edged bond. They are also important, issued by the company, and they show the ability of the firm to bear to pay the interest rate and to pay the principal amount with their comfortable profit. We have another type which is known as junk bond, and some other sources of the bonds are voting bonds, senior bonds and junior bonds. And keeping with the structure and the contents of bond analysis, we have various indicators that are used for evaluation of these bonds. Bonds are known, and that is how we can analyze the bonds. Are quantitative analysis, qualitative analysis. As far as quantitative analysis is concerned, financial ratios, they are computed, they are estimated about the financial situation, debt capacity and credibility of the company, issue of the bonds, and we can, on the basis of these investors, they have the guideline, and they can assess the situation that whether they should purchase the bonds or should not purchase the bond, depending upon the return and date of maturity and mode of payment. And all this basically help the individual investor about the investment in portfolio holding for their future. And we have ratios for the bond analysis. These financial ratios are the debt to equity ratio, debt to cash flows ratio, and debt coverage ratio, and cash flows debt service ratio. And all these are very much important. They provide the investors with the proper platform and stage to earn profit on their investment, and with minimum loss, with the minimum risk associated. And we can say that higher level ratios are there as indicator of the higher level of the risk. And we can say that we can obtain the data from the balance sheet, and on the basis of the data obtained from the balance sheet, we can calculate these ratios, and we can and the result of the ratio can indicate and can clarify the position and economic situation of the firm as far as the interest rate is concerned, as far as date of maturity of the bonds and principal amount concerned is concerned, and can make clear the situation to the investors in order to make their investment. This is today's lecture, and we will inshallah continue in the next class. And I hope you will be able to understand all these all these concepts in the light of the lecture, in the light of the slides, and with the referred book that we have been using in the last lectures. And take care of yourself, take care of your studies. Allah Hafiz. Up to next class.